Unit 20. 20.1. Listening 1. Concluding an unsuccessful negotiation.
The major sticking point at the moment seems to be staff training. What exactly are your objections to our proposal?
The problem is not with training so much as with staff retention. We are worried that the way the call centre industry is booming in India, and given the rapid staff turnover, our customers may be talking to people who are quite new to your company and who have not had enough training or experience with our products. We need some guarantees about the people who will be answering our customers.
I think we both need to give a little ground here. What do you think is a reasonable solution?
That you guarantee that all the employees answering our calls will have had at least 3 months working experience with bank products.
Well, I'm sorry, Mrs. Hewlett, but we cannot do that. Perhaps we should adjourn to reconsider our positions. Hopefully we can come back with some fresh ideas.
I'm sorry, but I don't think that would help. I've told you where we stand on this, and we can't change our position. And if you can't give us a guarantee on this, we'll have to look elsewhere. I'm afraid that we've reached a stalemate, so I think we should call it a day.
20.2. Listening 2. Concluding a successful negotiation.
OK, we can agree to that. The option will run until the end of the year. Can we just run through what's been agreed? We're going to deliver 500 T650 workstations at $1,450 each in 14 days, which is to say the 23rd of May, with a payment period of 60 days. These workstations will be fully guaranteed for 12 months, and you have an option to buy 200 more T650s at the same price until the end of the year. I expect you'd like that in writing. We'll draw up a full contract. Well, I think we've both got a good deal. I hope this can be the basis for a long-term relationship.
20.3. Listening 3. Saturday opening.
I saw the top secret Saturday report today.
Oh.
It's going to happen.
Not without negotiations with the Staff Association, it's not. So what are they planning?
I can't tell you.
Oh.
I told you it's confidential.
Oh, come on.
Well, OK. I think they're sending round a circular tomorrow anyway. So, they're planning to open most branches on Saturdays from 10 till 2 and to stay open an hour longer on weekdays.
And they think they're going to find enough volunteers to work on Saturday?
Oh no, not volunteers. They want to change all our contracts. Though, of course, not everyone will have to work at the weekend. At least, not every weekend.
I don't believe it. What are they offering in return?
2 hours off. A 2-hour reduction in the working week for all staff who work on Saturdays. Though the new branches will be so nice, people won't want to work less.
You must be joking.
I am joking. And they're going to create 25 new jobs, or 50 part-time ones. And there'll be an annual bonus for all staff if sales of banking products increase with the longer opening hours.
Yeah, but what if there isn't any increase in business and customers just come in at a different time? On Saturday instead of during the week? There'll be no bonuses.
They're convinced that won't happen.
Unit 21. 21.1. Listening 1. Asset management and allocation.
Asset management nowadays means managing financial assets, excluding real estate, works of art and things like that. Individual portfolios and institutional funds are very different because of size and objectives. There are many classes of possible investments in this area. Bonds, stocks, cash, precious metals, funds, and so on. Each of these classes contains a certain number and sometimes a very large number of subclasses like categories of bonds or international stocks of various countries. The problems for managing assets in this area concern, first of all, the objectives of the portfolio of the client and its size. The objectives of a private portfolio will depend on whether you invest for retirement or for use in the next few years. For instance, to buy real estate. Another major factor is size, because you can easily diversify and then steer a large portfolio, and it's sometimes much more expensive to do so for a small one. This problem of objectives and portfolio diversification has a direct impact on the returns which are needed or expected to meet these objectives, and the implied risk of these portfolios, a risk which depends largely on the returns that are expected. In practice, the two major questions which arise are, first, defining a strategy, and second, an investment style. The strategy, in fact, means asset allocation. You need to decide what proportion of the funds you'll invest in those various classes, bonds, stocks, and so on. The asset allocation is the key to the performance of the portfolio, whether it's between industries, between countries, or anything else. It is also the heart of the implementation of a reasonable diversification. Oh, but mind you, diversification can be overdone, and then it becomes a very expensive and unproductive exercise.
21.2. Listening 2. Investment styles.
The second point is style, which is very often not recognized by investors. There are a number of styles of investment management, the main ones being, first of all, growth investment, which, as the word says, is looking for growth, for capital accumulation, and looks for growth companies in growth industries. The second is value, which is the opposite of growth, which is conservative industries with high asset values and stable or low growing earnings. The third main style is the choice between large and small companies on the equity side. Large companies are supposed to be stable and more reliable. Small companies very often give a faster rate of growth but are more difficult to track and manage. Another point here is when you have invested your funds, you still have to manage your portfolio, which may take up to a year to build up. There are essentially two ways to manage a portfolio. One is active management, where you buy and sell quite frequently to adapt your portfolio to your objectives and to changing market circumstances. The other one is passive investment. You buy and hold, which used to be for many years, sitting on your positions until things fundamentally changed or bonds came to maturity. This has now been developed into index-linked portfolios, which try to follow stock market or bond market indices and replicate their movements. This can be a very attractive proposition, or not, considering that these portfolios go down with the market in negative times. A final important remark is that portfolios which are composed of funds also need to be managed. You cannot buy and sit on a fund portfolio indefinitely. Funds change. They change their management, they change their quality and their objectives. Therefore, just like an ordinary portfolio, a fund portfolio has to be managed too.
Unit 22. 22. Listening. The introduction.
Good morning, everybody. Thank you all for coming today. My name is Paula Foley, and I'm Vice President for Private Banking. This morning I'm going to talk about conservative portfolio strategies, because most of you are responsible for an increasing number of clients who choose this option. My presentation will take about 15 minutes, and as you can see, I've divided it into 4 parts. The first part will be about risk management in general. The second part looks at diversification, which is, of course, the most important concept of all. Then I'll talk about the use of indexed funds, and finally, I'll discuss capital preservation and capital accumulation. If anything isn't clear, or if you have any questions, please don't hesitate to interrupt. Okay, so what is risk management?
Unit 23. 23.1. Listening 1. The Financial Services Authority.
I think I'm correct in saying that the FSA came into existence on the 1st of June 1998. It was formed from 9 organisations, I believe, although it may be slightly more now because extra responsibilities have been added to its mandate. The creation of the FSA was in recognition of developments taking place in the financial markets, the way firms were organising themselves. The firms are not just banks anymore. They're more like financial conglomerates, and so there needed to be a way to ensure that the supervision of these firms is appropriate. The firms were becoming more and more integrated, and in order to make financial regulation more efficient, it was felt that the regulator in the United Kingdom should consider doing the same thing. So, the decision was made to establish an integrated financial regulator incorporating all of those different elements. When it's working with banks like ours, the FSA's main objective is to understand the institution, what it's currently doing and what it's seeking to do. The FSA is governed by statutory objectives such as protecting consumers and fighting financial crime. So that underpins all of its work. But the nature of its job in relation to us is to communicate with a wide range of people in the institution, both in our compliance department and at very senior executive levels. The FSA needs to understand our strategy as well as what we are doing on a day-to-day basis in terms of our products and of how we are treating our customers. These customers may be consumers, but they can also be what we would call wholesale counterparties, other banks that we deal with on a regular basis.
23.2. Listening to. Conflicts of interest.
We need to recognise that there have always been conflicts of interest. The crux of the problem is not the fact that we have them, but the way in which firms manage these conflicts of interest. Often it's about how you control information within financial institutions. Increasingly, different parts of the firm will interact with the same counterparty, but in different ways. For example, there has been a situation in the press regarding equity research, where research analysts have been used almost to promote investment banking. That's caused a number of problems because retail investors, certainly in the USA, have purchased shares in firms on the basis of the research analyst's recommendation. There has been a suggestion that the view the analysts gave on those firms was actually not their real view. Their private view was that the firms were not nearly as attractive as they stated publicly, but they made these statements because there was a chance that, if they did, then the firm would give investment banking work to the bank. Statistics in the UK show that the number of buy recommendations on firms substantially outweigh the number of sell recommendations on firms. So clearly there is a balance to be achieved here. There's also auditing. Certainly a number of auditing firms have realised that the set of skills that they have within the firm means they're often very well placed and legitimately placed to provide extra consultancy-style work. Again, that is not necessarily a problem. What needs to be monitored is how this is managed with respect to the relationship with the client of the auditor. But certainly I think it's fair to say that many auditing firms have recognised this conflict in recent years and have either separated their consultancy business from the auditing firm or have used other techniques to manage the potential conflict of interest. One of those has been, for example, that when they appoint an auditor, many clients now deliberately state that they will not use that firm for consultancy work. They will use another auditing firm for their consultancy work.
Unit 24. 24.1. Listening 1. Parts of a presentation.
Okay, so as I said, first of all, I'm going to talk about financial futures before moving on to options. As you probably know, futures were first traded on the... That's all I need to say about futures, so that completes the first part of my talk. Now let's turn to options, which are this department's specialty. That's all I'm going to say about options, so unless you have any questions, let's move on to the third part of my presentation, which is about swaps. As I said in my introduction, these fall into two main categories. interest rate swaps, and exchange rate swaps. I'll begin with interest rate swaps, which some of you may be... So that was interest rate swaps. Now we come to exchange rate swaps, which are still an important derivative instrument, even after the introduction of the euro.
24.2. Listening to. The end of a presentation.
Okay, that's all I have to say about capital preservation and accumulation. So now I'll just summarize my 3 main points again. A conservatively managed portfolio should be widely diversified. It should be expected to rise or fall in line with one or more major stock indices. And it's more important to preserve capital than to accumulate it. So to conclude, I have 2 recommendations. Firstly, I think we need to diversify our clients' portfolios more widely, probably across more than one stock market. And secondly, given the current volatility of the markets, I think we all need to pay more attention to preserving our clients' initial capital sums than to increasing them. Thank you all for your attention. Does anyone have any questions or comments?